Welcome to Capital Allocation Lab. If you value calm, fundamentals first lessons with no hype and no trading signals, please subscribe and like to support more educational episodes.
And as a standard reminder before we begin today's analysis, this discussion is for educational purposes only. It does not constitute individualized investment, legal, tax, or accounting advice. You should always conduct your own research or consult with a qualified professional before making any financial decisions.
Right. So today we have a highly specific analytical mission. We are taking a really systematic look at the special factors that can make a corporate bond or, any fixed income instrument appear significantly safer on paper than it actually is in economic reality.
Yeah, we're going to examine the architecture of capital structures. Specifically, we'll be focusing on how holding companies, certain accounting conventions, and layered obligations can obscure risk. Because the goal here is to train ourselves to look past the headline numbers and identify where the true structural vulnerabilities actually lie.
Exactly. And there is a vital premise we need to establish right away, particularly for those of you listening who consider yourselves strictly equity investors. You might question the utility of spending an hour dissecting bond analysis, historical utility holding structures, and old railroad debt.
Which is a fair question, but the principles of credit analysis are not isolated to bondholders. Understanding the precise hierarchy of claims, what is genuinely senior, what obligations are truly fixed, and the exact path cash takes before it reaches the bottom line, that is what makes you a competent judge of a business's fundamental quality and its downside risk.
It aligns perfectly with the core philosophy established in our source material today, which is simply this: debt has to be paid before hope gets paid.
I love that phrasing. Debt has to be paid before hope gets paid.
Right. Because when you purchase common stock, you are effectively purchasing a residual claim. You're buying the hope of future growth, the expectation of expanding margins, and the anticipation of multiple expansion.
But debt operates on a completely different physical reality. Debt is a contractual certainty. It represents an inflexible obligation that absolutely must be satisfied, regardless of the macroeconomic environment or, frankly, management's optimistic projections.
And if you cannot accurately measure the weight of that fixed obligation, you really have no framework for pricing the residual hope.
That's the precise distinction. Equity analysis often involves a high degree of qualitative forecasting. But credit analysis, it forces you to strip away the romance and focus strictly on the structural plumbing of the business.
So we're going to approach this very systematically today. Here's the roadmap. First, we'll begin by analyzing the discrepancy between parent company-only financial results and fully consolidated results.
Then from there, we're going to unpack the counterintuitive reality of how preferred stock at operating subsidiaries interacts with parent company debt.
After that, we'll examine the accounting treatment of minority interest and the hidden burdens that necessitate calculating what we call effective debt.
Yeah, and to ground all this theory, we'll apply the mathematics directly to two historical railroad examples.
Finally, we will analyze the critical distinction between fixed assets and working capital when assessing industrial liquidity.
The overarching theme, the thing you really need to keep at the forefront of your mind as we move through all these concepts, is this. You cannot accept a neat, mathematically sound ratio until you completely understand the corporate structure underneath it.
Absolutely. A calculation can be entirely accurate based on the inputs provided, but if those inputs represent an incomplete picture of the economic reality, the resulting ratio is not just useless, it is actively dangerous to your capital.
So let's begin with the first major structural vulnerability, which is the trap of relying on parent company-only financial statements.
Right. To understand why this is a trap, we first have to clearly define the mechanics of a holding company structure. In a holding company arrangement, the entity sitting at the very top of the corporate org chart, the parent, is frequently just a legal shell.
Yeah, it doesn't own the physical machinery, it doesn't employ the frontline workers, and it does not directly sell products or services to the end consumer.
The actual economic activity occurs beneath it, at the level of the operating subsidiaries. Those operating subsidiaries are the localized entities that actually generate the gross revenues.
And consequently, they're also the entities that incur the direct operating expenses. They absorb the costs of raw materials, the payroll, the maintenance, all of it.
Crucially, they are also responsible for servicing their own local capital structures, meaning they must pay the interest on any bonds they have issued directly, and they must pay the dividends on any preferred stock they have issued.
Exactly. And it is only after all of those localized senior burdens are met that any residual cash can be declared as a common dividend and sent upstream to the parent company.
So the analytical illusion occurs when an investor isolates the financial statements of that parent company and simply ignores the rest of the structure.
Right. A parent company-only income statement is fundamentally incomplete because it essentially begins halfway through the economic reality of the business.
The top line of a parent's income statement is not gross revenue from customers. It's the dividend income received from the subsidiaries.
Which means the statement begins after the subsidiaries have already engaged in the heavy lifting of paying their own bond interest, their own preferred dividends, and their own operational burdens. The vast majority of the enterprise's fixed obligations have already been processed completely out of view.
Let's clarify this with an analogy that translates these corporate structures into a more recognizable everyday scenario. Imagine a family business that owns and operates 3 separate local hardware stores.
Okay, 3 hardware stores.
The parent company, the headquarters, is just a small administrative office located in a downtown building. The headquarters itself has very few expenses, perhaps just a lease for the office space and a small administrative staff.
Right.
Now, headquarters only receives cash after Store A, Store B, and Store C have paid their individual commercial rent, their local payroll, and the interest on the specific bank loans taken out to stock their respective inventories.
So if you are an analyst looking exclusively at the headquarters books, the situation might look remarkably stable. You see a predictable stream of cash arriving from the 3 stores. Let's say it totals $1 million annually.
Okay, $1 million coming in.
And then you look at headquarters' own fixed administrative expenses, which sit at $100,000. The simple division yields a coverage ratio of 10 times.
Right, 1 million divided by 100,000.
Exactly. And 10 times coverage suggests an immense margin of safety. You might conclude that headquarters is an incredibly safe credit risk.
But that 10 times coverage ratio totally masks the severe operational leverage embedded at the local level. Suppose Store A generates $2 million in gross revenue, but its local operating expenses, its lease, and its bank loan obligations consume $1.9 million of that revenue.
Wow, okay. So the store is operating on a razor-thin margin just to generate the $100,000 it eventually sends upstream to headquarters.
Yes, and if local revenues at store decline by merely 5%, the store can no longer cover its own local bank loan. It certainly cannot send any cash upstream to the parent.
The parent company's perceived safety is entirely dependent on the continuous, uninterrupted success of that highly leveraged local operation. The 10 times coverage at the headquarters level is an arithmetic fact, but it is an economic fiction.
Which establishes the first absolute rule for analyzing a complex corporate structure. You must insist on a fully consolidated income statement.
A consolidated statement aggregates the parent and all underlying subsidiaries into a single unified financial picture. It forces you to look at the total gross revenues generated across the entire system against every single expense, interest payment, and preferred dividend obligation the system bears.
We actually have a precise historical example to illustrate the magnitude of this distortion. Let's examine the financial reporting of the standard gas and electric system during the early 1930s.
Yeah, we need to look closely at the reported math here because it perfectly demonstrates how widely the parent-only numbers can diverge from the consolidated reality.
If you looked at standard gas and electric on a parent company-only basis, the financial statements reported a balance available for fixed charges of $16.5 million. And against that available balance, the parent company reported fixed charges of $4.7 million.
When we calculate the margin of safety based on those parent-only figures, we divide the $16.5 million available by the $4.7 million in fixed charges. That yields a coverage ratio of 3.48 times.
And for a utility holding company in that era, 3.48 times coverage indicates a highly comfortable position. An investor analyzing those specific numbers would reasonably conclude that the parent company's bonds were well protected.
However, the perspective changes violently when we apply the rule of consolidation. When the analyst pulled the fully consolidated financial statements encompassing the entire system of operating subsidiaries, the scale of the enterprise expanded, but so did the leverage.
Dramatically. On a consolidated basis, the system-wide balance available for fixed charges was $57.2 million. But the system-wide fixed charges, meaning the total burden of all the subsidiary debt combined with the parent debt, amounted to $42.2 million.
The recalculation reveals the true margin of safety. We take the consolidated $57.2 million available and divide it by the consolidated $42.2 million in fixed charges.
And the coverage ratio collapses. It goes from 3.48 times to just 1.36 times.
That is an uncomfortably thin margin, particularly for a highly indebted infrastructure system entering an economic depression. The parent company early presentation suggested a fortress, but the consolidated presentation revealed a structure carrying a massive system-wide burden with very little room to absorb an operational shock.
The broader lesson derived from this mathematical disparity is the concept of structural subordination. Structural subordination dictates that the further removed you are from the actual physical operating assets, the machinery that produces the cash, the more vulnerable your position is.
Because the operating subsidiaries hold the assets and generate the cash locally, the creditors of those subsidiaries have the first claim on the cash flows.
The subsidiary's localized debt is structurally senior to the parent company's debt, simply by virtue of geography and corporate boundaries. The parent's creditors are subordinate to everyone at the operating level, regardless of what the parent's bond indenture might claim.
And that reality leads directly into the second major structural dynamic we need to examine: the subtle and often misunderstood seniority of subsidiary preferred stock.
This particular concept challenges a deeply ingrained assumption that most investors hold. The standard assumption in corporate finance is that bonds, representing a legal debt obligation, are always senior to preferred stock, which is an equity instrument.
And in a simple, single-entity capital structure, that rule holds entirely true. A single company must pay its bondholders before it can pay its preferred stockholders.
But holding company structures are not single entities. They are layered hierarchies. And in a holding company hierarchy, the preferred stock issued by an operating subsidiary is economically senior to the bonds issued by the parent company.
We really need to trace the exact path the cash takes to understand why this hierarchy exists. Let's start at the very bottom of the structure, at the operating subsidiary level. The subsidiary generates cash from its daily operations.
Right. And the subsidiary must satisfy its localized claims in a strict sequential order. The absolute first claim on that cash is the interest owed on the subsidiary's own local bonds.
Once those localized bondholders are paid, the subsidiary must then satisfy the dividends owed on its own localized preferred stock.
Exactly. It is only after the subsidiary's bonds and the subsidiary's preferred stockholders are fully paid that the subsidiary has the legal and financial authorization to declare a dividend on its common stock. And it is that common stock dividend that is sent upstream to the parent company.
Meanwhile, the parent company, sitting at the top of the structure, relies entirely on that incoming common dividend to fund its operations. When the parent company receives that cash, it then uses it to pay the interest on the parent company's bonds.
So if we map out the complete sequence, the subsidiary's preferred stockholder is sitting at step 2 in the cash waterfall, while the parent company's bondholder is sitting way down at step 4.
The cash simply must flow through and satisfy the lower-level preferred equity claim before it is legally permitted to travel upstream to satisfy the higher-level debt claim.
In practical economic terms, the label of bond at the parent level does not grant you seniority over the label of preferred stock at the subsidiary level. The subsidiary preferred stock functions as a structurally senior claim.
However, we must introduce a necessary nuance to this rule. The economic seniority of the subsidiary preferred stock is absolute regarding the cash flows of that specific subsidiary. But holding companies often own multiple operating entities.
Right, so if a parent company owns 10 distinct operating utilities and one of those specific localized utilities becomes unprofitable, that single troubled subsidiary might be forced to suspend its specific preferred dividends.
But simultaneously, the other 9 healthy subsidiaries might continue generating robust cash flows, paying their own preferred dividends, and sending enough residual common dividends up to the parent to allow the parent to successfully pay its own bond interest.
In that specific scenario, the parent's bonds survive while a subsidiary's preferred stock is suspended. The structural rule applies to the flow of cash, but a diverse portfolio of subsidiaries can provide the parent company with multiple redundant pathways for cash to reach the top.
That diversification is a protective factor. But when systemic stress fractures the entire holding company architecture, the structural reality asserts itself brutally.
We can examine the events surrounding the New York Water Service in August of 1931 to see exactly how this plays out. This requires outlining a 3-tiered corporate cake.
Okay, at the foundational operating level, we had the New York Water Service, which issued its own preferred stock to the public. New York Water Service was wholly owned by an intermediate holding company named Federal Water Service.
And Federal Water Service was, in turn, controlled by a top-level parent holding company known as Tri-Utilities.
So the hierarchy is established. New York Water Service preferred stock sits beneath Federal Water Service, which sits beneath Tri-Utilities.
Then, in August of 1931, the top-level parent, Tri-Utilities, found itself unable to meet its vast obligations and collapsed into receivership.
Now, the crucial detail here is the operational health of the entity at the very bottom. New York Water Service was an operating utility providing a basic necessity. It was fundamentally sound.
In fact, its income had actually increased relative to the previous year. It was generating ample cash, and mathematically, the dividends on its preferred stock appeared to be well-earned and entirely secure.
Yet despite the underlying operational health of the local utility, the dividends on those underlying preferred issues of the New York Water Service were discontinued.
The preferred stockholders at the operating level were cut off, even though their specific company was highly profitable.
This occurs because investment protection is not merely a function of localized profitability. It is dictated by the integrity of the broader structure that capital and control move through.
When the apex of the structure, Tri-Utilities, broke and entered receivership, it created systemic paralysis. A receivership introduces court-appointed overseers, freezes strategic capital movement, triggers complex legal battles among creditors at various levels, and fundamentally alters the operational mandate of the entire system.
The parent's insolvency trapped the capital below. The preferred stockholders of the localized New York Water Service discovered that the practical protection they believed they possessed was entirely dependent on the solvency of the holding company apparatus, sitting 2 levels above them.
When the architecture collapsed, their localized seniority became irrelevant.
This historical event underscores a critical analytical mandate. You were never simply analyzing the unit economics of a standalone business. You were analyzing a complex legal and financial architecture.
If the superstructure is over-leveraged and fragile, your investment at the subsidiary level remains vulnerable, regardless of how stable the local revenues appear. A fundamentally sound business trapped at the bottom of a collapsing corporate structure cannot insulate its investors from the chaos above.
This principle of structural distortion leads directly into our third area of focus, which is accounting for minority interests.
This is a technical area of consolidated accounting where standard reporting conventions consistently produce a margin of safety that looks far more robust than it truly is. To dissect this, we first must define what a minority interest actually represents in a corporate structure.
When a parent company acquires a subsidiary, it does not always purchase 100% of the equity. Suppose a parent company purchases exactly 80% of an operating subsidiary's common stock.
The remaining 20% remains in the hands of outside investors. That outstanding 20% is defined as the minority interest.
The accounting complication arises when the parent company prepares its consolidated financial statements. Under standard accounting rules, because the parent company exerts operational control over the subsidiary, it is generally required to consolidate 100% of that subsidiary's revenues, expenses, and gross earnings onto the parent's income statement.
The parent consolidates the entirety of the subsidiary's earning power, even though it only possesses an 80% economic claim on the residual profits. This is the source of what we term the flatter factor.
It artificially flatters the perceived safety of the parent company's fixed obligations. On the consolidated income statement, the portion of the earnings that legally belongs to that 20% minority stock is typically deducted quite far down the page, often after the parent company's bond interest expense has already been calculated and presented.
This presentation is highly deceptive for credit analysis. If you calculate your interest coverage ratio using the total consolidated earnings pool before deducting the minority interest, you are effectively taking credit for cash flows that do not legally belong to the parent company.
You are inflating the denominator of your safety test with someone else's money. The strict conservative method, the only method appropriate for rigorous security analysis, demands that you deduct the minority interest share of the earnings before you calculate your interest coverage ratio.
You must test your fixed obligations exclusively against the earnings that truly and fully belong to the parent company's shareholders.
We can clarify the magnitude of this distortion with a straightforward mathematical illustration. Imagine you are reviewing a consolidated income statement. The standard presentation shows a total of $60 million in earnings available to pay fixed charges.
Okay, $60 million available.
And the company's total interest expense is $30 million. If you perform the standard calculation, dividing the $60 million available by the $30 million in interest, you arrive at a coverage ratio of exactly 2 times.
A 2 times coverage ratio is historically viewed as a respectable, solid metric. It suggests a comfortable buffer.
But an analyst must read the footnotes. Upon deeper inspection, you discover that $12 million of that $60 million earnings pool actually belongs to the minority owners of various subsidiaries.
The parent company has no legal right to distribute that $12 million to its own bondholders. Therefore, we must apply the conservative view. We must remove the illusion.
Under the conservative method, we take the $60 million in total earnings and immediately subtract the $12 million that belongs to the minority interest. That leaves us with a true attributable earnings pool of $48 million.
Now we recalculate the margin of safety. We take the $48 million of attributable earnings and divide it by the $30 million in interest expense.
The coverage ratio immediately drops from 2 times to 1.6 times.
A reduction from 2 times coverage to 1.6 times coverage is not a marginal adjustment. It represents a fundamental shift in the risk profile of the investment.
Psychologically and analytically, 2 times coverage provides a sense of security. It implies the company can suffer a 50% decline in earnings and still meet its obligations.
But 1.6 times coverage is a warning sign. It demands intense scrutiny. It indicates that the margin of error is uncomfortably thin. By accepting the standard accounting presentation, an investor remains completely blind to the reality that their margin of safety is materially weaker than reported.
In credit analysis, erring on the side of caution is the paramount directive. If any portion of the earning power belongs to a third party, it must be removed from the equation before you attempt to quantify your safety.
That rigorous approach to defining what is truly available to pay obligations brings us to Part 4, the necessity of capitalizing fixed charges to determine a company's effective debt.
This requires looking past the explicitly labeled liabilities on the balance sheet and recognizing the economic reality of the income statement. Most investors simply open a financial report, scan the balance sheet, locate the line item labeled long-term debt or funded debt, and assume that number encapsulates the entirety of the corporation's fixed leverage.
That assumption is fundamentally flawed because debt is not restricted to formal bond issuances. A corporation can obligate itself to massive, inflexible payments without ever issuing a traditional bond.
Effective debt encompasses guaranteed stocks, where a parent guarantees the dividend of another entity. It includes long-term, non-cancelable annual rental obligations for leased property or equipment. And, as we established earlier, it includes the non-guaranteed preferred stocks of operating subsidiaries that sit ahead of the parent's claims.
Analytically, any recurring, unavoidable payment that functions legally or economically as a senior claim is debt. The specific accounting terminology, whether it is labeled a lease, a guarantee, or a preferred dividend, is irrelevant.
If the corporation must meet the payment to avoid default or structural collapse, it operates with the exact same gravity as funded debt.
So the analytical challenge is figuring out how to aggregate these disparate obligations, leases, guarantees, preferred dividends, and traditional interest into a single comparable metric. How do we translate an annual rental payment into a principal debt equivalent?
We utilize a classic analytical technique. We convert the stream of fixed charges into a principal equivalent by calculating the effective debt.
The mathematics behind this conversion are straightforward but powerful. You aggregate the total comprehensive annual fixed charges encompassing every interest payment, lease obligation, and subsidiary preferred dividend.
You then capitalize that total annual figure at an assumed historical interest rate. In the analytical framework provided by our source material, the standard historical rate applied to these calculations is 4.5%.
Let's deconstruct the logic of this mathematical conversion. When you capitalize a stream of annual payments at 4.5%, you are essentially asking a reverse engineering question. How large of a principal loan, bearing an interest rate of 4.5%, would necessitate this specific annual payment?
Mathematically, you achieve this by dividing the total annual charge by 0.045. A simpler shorthand, explicitly provided in the source material, is to multiply the annual charge by roughly 22.
To illustrate, suppose a corporation reports $45 million in comprehensive annual fixed charges. To determine the economic weight of those charges, we calculate the effective debt. We take the $45 million and multiply it by 22.
The calculation yields approximately $1 billion in effective debt.
Consider the implications of that calculation. The company's balance sheet might prominently display only $500 million in official funded debt.
An investor looking solely at the balance sheet would severely underestimate the leverage. The reality of their comprehensive fixed commitments means the enterprise is actually laboring under the economic equivalent of $1 billion in debt.
Recognizing effective debt radically alters your assessment of the company's financial risk.
This realization establishes a crucial base rule for conservative credit analysis. When you are attempting to calculate coverage ratios and effective debt, you must continually compare two distinct figures from the income statement: the fixed charges and the net deductions.
The ironclad rule is that you must base your calculations on whichever figure is larger. You must deliberately select the stricter, more punitive figure to ensure you are not allowing an artificially low denominator to make a bond appear safer than it is.
To clarify the terminology, fixed charges traditionally refers to the explicit interest payments on the formal funded debt.
Right, while net deductions represents a much broader, more comprehensive category. Net deductions capture the interest, but they also pull in the lease rentals, the guarantees, the subsidiary preferred dividends, and all other recurring structural burdens that are subtracted from revenues before arriving at the final net income figure.
Exactly. If the net deductions figure is larger than the strictly defined fixed charges figure, it is a definitive signal that the corporate structure harbors hidden burdens. By mandating the use of the higher number as the base for calculating effective debt and coverage, you force those hidden burdens into the light.
You refuse to give the corporation the benefit of the more flattering accounting presentation.
The theory is sound, but its true value is only revealed in its application. Let's move to part 5, where we will apply this precise mathematical framework to a historical comparison, a tale of two railroads.
We are going to analyze two massive infrastructure companies operating during the severe economic contraction of 1932 to demonstrate how drastically different the underlying realities can be, despite what the basic balance sheets might suggest.
We will begin with example 1, the New York, New Haven, and Hartford Railroad in 1932. We will strictly adhere to the analytical rules we just established. Step 1 is to compare the comprehensive burdens.
The railroad's net deductions for the year were $18.5 million. Its explicitly labeled fixed charges were $17.4 million.
The rule is applied automatically. $18.5 million is greater than $17.4 million. Therefore, we discard the smaller figure and establish $18.5 million as our strict mathematical base for the analysis.
Step 2 is to calculate the effective debt. We must capitalize that $18.5 million base to determine the true weight of the leverage. Using our established multiplier, we multiply $18.5 million by roughly 22.
The resulting calculation reveals an effective debt load of approximately $408 million.
This is where the analysis exposes the hidden risk. We now compare our calculated effective debt against the company's own balance sheet. The New York, New Haven, and Hartford Railroad reported formal funded debt of only about $258 million.
The disparity is alarming. The balance sheet suggests the enterprise must support $258 million in leverage. The economic reality, captured by capitalizing the net deductions, proves the enterprise is actually struggling under the equivalent of $408 million in effective debt.
There is a massive structural discrepancy hiding immense leverage that the balance sheet entirely fails to convey.
Step 3 requires us to assess the equity cushion. The equity cushion represents the actual market value sitting beneath the debt structure. How much real financial value exists to absorb losses before the bondholder's principal is impaired?
To determine this, we examine the market value of the railroad's outstanding stock. In 1932, the New Haven had 490,000 preferred shares outstanding, trading at a market price of $50. That equates to roughly $24.5 million in preferred equity value.
They also had 1.57 million common shares outstanding, trading at 22. That equates to roughly $34.5 million in common equity value.
When we aggregate the preferred and common shares, the total market value of the stock, the total equity cushion, is roughly $59 million.
We now possess the two critical variables to assess the structural integrity: an equity cushion of $59 million, attempting to support a massive effective debt burden of $408 million.
When we calculate the ratio, we find a stock-to-bond ratio of approximately 1 to 6.9. For every single dollar of market-valued equity, there are nearly $7 of effective debt pressing down on the structure.
That is an incredibly thin, highly fragile equity cushion, offering virtually no protection against sustained operational losses.
The income statement confirms the extreme fragility indicated by the balance sheet analysis. In the severely depressed conditions of 1932, the railroad's coverage ratio was only 0.93 times. The enterprise was not generating sufficient earnings to cover its annual deductions.
Even extending the view to a 7-year average, which includes more prosperous years, the coverage ratio was a meager 1.57 times.
The analytical verdict on the New York, New Haven, and Hartford Railroad in 1932 is unequivocal. The bonds offer weak protection. Under rigorous, conservative analysis, these bonds are not a sound purchase.
This perfectly illustrates a foundational principle of credit analysis. A fundamentally flawed bond is not magically rendered safe by its legal designation. The fact that the instrument is legally senior in the capital structure is meaningless if the underlying economics of the enterprise are collapsing beneath the unmanageable weight of effective debt.
We must contrast that failure with a structure built on actual strength. This brings us to example 2, the Chesapeake and Ohio Railway, operating in the exact same difficult macroeconomic environment.
We deploy the exact same methodical process. Step 1, compare the burdens. The Chesapeake and Ohio's explicitly labeled fixed charges were $10.76 million. Its net deductions were $9.87 million.
Applying the strict rule, we see that the fixed charges of $10.76 million are greater than the net deductions of $9.87 million. Therefore, we use $10.76 million as our mathematical base.
Step 2, calculate the effective debt. We capitalize the $10.76 million base, multiplying it by roughly 22. The calculation reveals an effective debt load of approximately $239 million.
We immediately cross-reference this calculation against the company's reported balance sheet. The Chesapeake and Ohio reported formal funded debt of approximately $222 million.
The comparison here is highly instructive. We have $222 million in reported debt versus $239 million in effective debt. The gap is minor.
In this instance, the balance sheet provides a highly honest, transparent representation of the company's actual leverage. There are no massive hidden rental obligations or guaranteed layers artificially compressing the reported debt figure.
Step 3 requires calculating the equity cushion. The Chesapeake and Ohio had 7.65 million common shares outstanding, trading at a market price of 38. That calculation yields a total equity market value, a total equity cushion of approximately $291 million.
We now compare the components. We have a robust $291 million equity cushion sitting beneath $239 million of effective debt. The resulting stock-to-bond ratio is approximately 1 to 0.82.
I want to emphasize the significance of that math, 1 to 0.82. The market value of the equity is actually larger than the total burden of the debt. There is more stock value providing a protective buffer behind the debt than there is debt itself.
The magnitude of that cushion completely inverts the fragile dynamic we analyzed with the New Haven Railroad. And just as before, the earnings coverage confirms the structural strength.
Even in the depths of the 1932 depression, the Chesapeake and Ohio maintained a coverage ratio of 3.21 times. On a 7-year average, the coverage was an exceptionally robust 3.80 times. And the verdict here is equally unequivocal: strong protection. These bonds represent a justifiable purchase. The analysis reveals transparent accounting, low effective leverage relative to the asset base, massive equity support derived from the market's assessment, and demonstrably strong earnings coverage, even under severe macroeconomic stress. This comparison yields a profound lesson regarding the utility of junior securities in analyzing senior debt. The aggregate market value of a company's stock is not an infallible measure of intrinsic value. The equity markets are prone to volatility, irrational exuberance, and unjustified pessimism.
However, for the bond analyst, the total market value of the equity serves as an essential real-time stress signal. It provides a vital indication regarding the perceived thickness of the equity buffer.
When the collective judgment of the equity market values the junior position at a mere $59 million against a crushing $408 million in effective debt, as we saw with the New Haven, the market is screaming a warning. It is signaling that the enterprise is precariously close to insolvency, and the bondholder's principal is in imminent danger.
Conversely, when the market values the equity at $291 million against $239 million in debt, as with the Chesapeake and Ohio, it is signaling deep confidence in the enterprise's enduring earning power and providing tangible evidence of a massive protective buffer for the senior creditors.
We have meticulously analyzed holding company traps, the structural seniority of subsidiary preferred stock, the distortions of minority interests, the necessity of calculating effective debt, and the vital importance of the equity cushion.
All of these factors involve analyzing the composition and hierarchy of the capital structure. We must now pivot to part 6, where the analytical focus shifts from structural leverage to pure, unadulterated operational liquidity. We must examine the paramount importance of working capital in industrial enterprises.
To properly assess liquidity, an analyst must establish a firm conceptual distinction between fixed assets and current assets, and understand exactly why fixed assets provide a dangerous illusion of safety for bondholders during an economic contraction.
Fixed assets represent the physical infrastructure of the business, the sprawling manufacturing facilities, the highly specialized assembly line equipment, the heavy machinery.
The danger lies in conflating the accounting book value of those fixed assets with their actual utility during a crisis. The discrepancy arises from the difference between going concern value and liquidation value.
A highly specialized factory designed to manufacture a proprietary automotive component might have required $100 million to construct. On a functioning balance sheet, operating in a healthy economy, it is accurately recorded as a massive, valuable asset.
However, if the macroeconomic environment collapses and the company is forced into bankruptcy, that accounting value vaporizes. You cannot quickly convert a massive, specialized factory into ready cash at anything remotely approaching its historical cost. In a severe downturn, there are no buyers for specialized capacity.
That illiquidity forces the analyst to focus intensely on current assets. Current assets sit far closer to monetary reality. We are referring to cash reserves, easily liquidated marketable securities, outstanding accounts receivable from customers, and the physical merchandise inventory waiting to be sold.
These are the specific assets that possess the velocity required to help a company bridge a period of negative cash flow. They can be converted into the cash needed to service debt far more reliably and rapidly than specialized real estate.
The relationship between current assets and short-term obligations defines the critical metric of working capital. Working capital, which is synonymous with net current assets, is strictly defined as the mathematical excess of current assets over current liabilities.
Current liabilities represent the immediate demands on the company's cash. The short-term debts, the accounts payable to suppliers, the payroll obligations, and the bills that absolutely must be paid within the next 12 months.
The calculation is straightforward. If an industrial enterprise possesses $200 million in current assets and is facing $100 million in current liabilities, the enterprise has a working capital position of $100 million.
Determining the absolute dollar figure of working capital is only the preliminary step. The source material outlines 3 distinct, crucial tests that an investor must apply to a company's working capital position to verify its adequacy.
Test 1 requires the analyst to ensure the enterprise maintains ample, unencumbered cash holdings.
Test 2 requires the verification of a strong current ratio.
And Test 3, which is the most stringent and frequently overlooked standard, requires the analyst to ensure there's a suitable proportion of working capital relative to the total funded debt.
Test 3 is the crucible. Most investors are trained to calculate a basic current ratio, but comparing the liquid working capital directly against the massive long-term funded debt introduces a much stricter standard of financial discipline.
Let's utilize a mathematical illustration to demonstrate how a company can easily pass the conventional liquidity test while completely failing the strict structural test.
Consider a hypothetical industrial company. The balance sheet shows current assets totaling $200 million. The current liabilities are $100 million. However, the company also carries a long-term funded debt burden of $180 million.
Let's run the sequential tests. Test 2 involves the standard current ratio, which is calculated by dividing current assets by current liabilities. We divide $200 million by $100 million, resulting in a ratio of 2 to 1.
In conventional financial analysis, a 2.1 current ratio is considered a strong indication of short-term liquidity. The company comfortably passes Test 2.
The illusion of safety shatters when we apply Test 3, comparing working capital to the funded debt. First, we calculate the working capital by subtracting the $100 million of current liabilities from the $200 million of current assets, leaving exactly $100 million in working capital.
Next, we compare that $100 million liquid cushion against the $180 million of long-term funded debt. The $100 million in working capital is significantly less than the $180 million in funded debt. The company outright fails Test 3.
The implications of that failure are profound for a bondholder. It means that the company's near-term operating liquid cushion, the capital it actually possesses free and clear after satisfying immediate obligations, is mathematically insufficient to offset the total weight of the long-term debt burden.
Failing this test does not imply the company is facing imminent bankruptcy next week, But it does mean that the bondholder cannot rely on the internal liquidity of the enterprise to guarantee their principal if the operating earnings suddenly collapse. The company remains dependent on external refinancing.
To protect investors from this specific vulnerability, the source material establishes two highly conservative guideposts specifically designed for industrial companies. Guidepost 1 dictates that current assets should generally be at least double current liabilities. This establishes the baseline 2-to-1 current ratio.
Guidepost 2, the more severe standard, dictates that the working capital position should be at least equal to the total amount of bonded debt. This establishes a strict 1-to-1 ratio between free short-term liquidity and total long-term leverage.
The requirement that working capital must equal bonded debt is a brutally strict standard. It demands that an enterprise maintain an immense, highly inefficient hoard of liquidity simply to justify its borrowing. Many modern analysts would argue such a standard is unduly severe and penalizes capital efficiency.
The authors of the source material explicitly acknowledge the severity of the standard. However, they justify it by presenting undeniable historical proof forged in the ultimate macroeconomic crucible. They analyze the specific industrial companies that managed to maintain their pristine investment rank straight through the absolute depths of the 1932 economic depression.
The defining characteristic of those survivors was unmistakable. Every single one of those elite companies possessed working capital that exceeded their total outstanding bonds.
The historical data becomes even more staggering when we look at the composition of that working capital. The authors examined 18 specific industrial companies that survived the 1932 stress test, with their investment rank entirely intact, companies like General Baking.
Of those 18 elite survivors, 13 of them possessed cash assets alone that exceeded their total funded debt.
Consider the absolute fortress-like financial strength required to achieve that metric. These enterprises did not merely possess sufficient inventory and receivables to equal their debt. They possessed pure, unencumbered cash sitting in bank accounts that was larger than their entire long-term debt burden.
An enterprise operating with that level of liquidity is practically impervious to credit market freezes or banking panics. When macroeconomic conditions deteriorate severely, liquidity is what preserves strategic choice.
A company holding cash in excess of its debt can endure years of shrinking operating margins, severely delayed customer receivables, and massive inventory write-downs. They entirely control their own destiny.
Conversely, a company operating with thin liquidity during a crisis immediately becomes a hostage to the kindness of external lenders, who are usually panicked themselves.
We must introduce a necessary caveat regarding these strict liquidity rules because the fundamental context of the industry matters immensely. The source material explicitly notes that certain specific types of business models naturally require significantly less working capital to operate safely.
They specifically highlight businesses such as commercial baking operations, ice companies, and restaurants.
This requires applying critical thinking to the underlying operational mechanics. Why do bakeries and restaurants require a fraction of the working capital needed by a heavy manufacturer?
The answer lies in the velocity of inventory turnover and the immediacy of cash collection. A commercial bakery purchases raw flour on a Monday, bakes the bread on Tuesday, and sells it to a customer for cash on Wednesday.
They do not maintain massive quantities of static merchandise inventory, nor do they extend huge amounts of credit, tying up capital in 90-day accounts receivable. Because the cash conversion cycle is incredibly rapid, hoarding massive amounts of static working capital is not a structural requirement for their survival.
This operational reality also explains the historical contrast between industrial companies and heavy infrastructure enterprises like railroads and public utilities. Historically, railroads and utilities operated with entirely different liquidity profiles.
Exactly. Railroads and utilities are overwhelmingly capital-intensive regarding fixed assets. They deploy massive capital to build rail networks and power generation plants. But they do not finance massive, slow-moving merchandise inventories, nor do they act as a bank extending huge credit lines to their customers in the way a manufacturing firm does.
Historically, they operated with very thin layers of working capital because their revenues were highly predictable, and they believed they could continually access the capital markets to roll over their debt.
However, it is vital to note that the severe lessons of the Great Depression demonstrated that even highly predictable utilities and railroads benefit massively from maintaining a robust emergency cash cushion when the capital markets unexpectedly freeze.
We have systematically covered an immense amount of structural, accounting, and mathematical theory today. We have reached Part 7, the final checklist and recap.
The objective of this episode is to provide a functional framework. If you want to rigorously apply this analytical discipline to the next complex capital structure you encounter, you require a standardized checklist.
The source material distills this entire methodology into 9 practical, mandatory questions. We are going to walk through each of these questions verbatim to ensure the framework is explicitly clear.
Question 1. Are you looking at the right entity? This demands that if the business structure incorporates subsidiaries, you absolutely must not stop your analysis at the parent company level. You must demand the consolidated view to understand the total burden.
Question 2. What claims get paid first? This requires analyzing the structural seniority across the entirety of the corporate group. You cannot rely on the legal seniority defined inside one specific company. You must trace the cash waterfall from the operating asset up to the parent.
Question 3. Are there hidden fixed obligations? This forces the analyst to scour the footnotes for lease rentals, guaranteed payments to external entities, and crucially, the preferred dividend obligations at the subsidiary level that function as debt.
Question 4. Is minority interest accounted for? This addresses the flatter factor. You must determine if the presence of minority shareholders reduces the actual earnings attributable to the parent company far more than the standard accounting presentation suggests.
Question 5. What is the effective debt? If you rigorously translate all the recurring fixed structural burdens into their principal debt equivalents, does the true economic leverage of the enterprise look meaningfully higher than the reported balance sheet debt?
Question 6. Is coverage strong using stricter denominators? This enforces the mathematical rule. You must always calculate your margin of safety using the larger of the two figures, either the explicitly defined fixed charges or the comprehensive net deductions.
Question 7. How thick is the equity cushion? This requires utilizing the stock market as a stress test. You must calculate exactly how much market-derived equity value truly sits beneath the debt structure to absorb potential losses.
Question 8. What does liquidity look like? This demands a severe examination of the current assets. You must evaluate the unencumbered cash, the standard current ratio, and most importantly, the ratio of total working capital relative to the total funded debt, completely ignoring the specialized fixed assets.
Question 9. Are the rules appropriate for the business model? This requires contextual intelligence. You must ensure you are not blindly applying rigid ratios across vastly different industries and that you are not being fooled by an illusion of comparability that does not reflect the operational reality of the business.
That 9-question checklist is an incredibly demanding analytical tool. It is designed to strip away the accounting optimism and force the investor to confront the cold, hard mechanics of the business structure. To permanently solidify this framework, we will conclude with the 10-point recap drawn directly from the source material. We will review these principles slowly and deliberately.
Point 1. Do not trust parent company-only results for judging the safety of parent bonds in a holding company system. Insist on a fully consolidated view.
Point 2. Remember that subsidiary bond interest and subsidiary preferred dividends can be economically senior to parent bond interest because the parent depends entirely on upstream common dividends.
Point 3. Include fixed commitments that function like debt, including relevant lease rentals and similar recurring obligations, instead of hiding behind narrow accounting labels.
Point 4. Treat minority interest conservatively when calculating earnings coverage. If a meaningful portion of the earnings legally belongs to others, do not count all of it as if it were fully available to the parent.
Point 5. Estimate effective debt when the formally reported debt understates the true fixed burden. Economic leverage always matters more than the accounting presentation.
Point 6. When choosing between different measures or denominators in your calculations, always use the more demanding one if your primary goal is assessing safety.
Point 7. Examine the total market value of the junior securities as one additional critical test of the true equity cushion residing behind the debt.
Point 8. For industrial bonds specifically, study the working capital position closely. Ample cash holdings, a strong current ratio, and substantial working capital relative to funded debt all matter immensely.
Point 9. Do not apply any single financial ratio mechanically across all industries. Business model differences fundamentally matter, but the ultimate need for reliable liquidity never disappears.
And finally, point 10, which represents the deepest philosophical lesson of the text. Good analysis is not just about calculating neatly. It is about seeing clearly what stands ahead of you in the capital structure, what specific cash flows depend on what operations, and where the hidden structural fragility lives. Great analysis is not just calculating nicely, but classifying correctly.
Classifying correctly is the foundational secret of rigorous analysis. If you incorrectly classify a massive non-cancelable lease as a mere operating expense instead of recognizing it as effective debt, your subsequent mathematics will execute perfectly, but your ultimate conclusion regarding the safety of the enterprise will be completely wrong.
As we conclude today's analysis, we need to return to the premise we established for the equity investors listening. This intense detour into bond mechanics, holding company hierarchies, and coverage denominators is fundamentally a lesson in corporate reality. Conservative credit analysis is the precise process of locating exactly where unwarranted optimism has sneaked into the financial presentation.
It is the specific discipline required to distinguish a true, durable investment from disguised, highly leveraged speculation. When you deeply comprehend the gravity of fixed debt, when you map out how a minor operational hiccup at a localized subsidiary could freeze the cash flow of a massive parent company, you realize just how incredibly fragile an over-leveraged equity position truly is.
This rigorous process trains you to value enterprises possessing fortress balance sheets, massive redundant cash reserves, and clean, transparent corporate structures. You stop accepting the optimized headline numbers fed to you by management, and you start demanding proof of structural safety.
We want to leave you with a final, provocative consideration regarding everything we have discussed today. We have spent an hour detailing how complex corporate structures can obscure massive risks and hidden leverage. But it is essential to consider the inverse scenario. How frequently does a complex corporate structure actually hide value?
If massive liabilities and vulnerabilities can be legally buried in unconsolidated subsidiaries, is it not entirely possible that incredible, unencumbered assets, vastly underappreciated cash flows, and massive hidden equity cushions are buried within those exact same complex structures?
Those hidden treasures are simply waiting for an analyst who possesses the discipline to execute the fully consolidated math and map the true cash waterfall. It is a concept that demands your consideration the next time you encounter a financial statement that initially appears unnecessarily complicated.
The analytical tools we discussed today are entirely neutral. They work in both directions. The rigorous discipline of unwinding a corporate structure always reveals the underlying economic truth, whether that truth exposes a hidden trap that destroys capital or reveals a hidden treasure that the broader market has failed to price correctly.
It all comes down to doing the work, parsing the structure, and refusing to accept the easy numbers at face value.
Thanks for joining.
Our mission is to revisit the classic books of investing and economics, translate their principles into today's decision-making, and help long-term investors improve judgment one concept at a time.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And leave a comment with your question, your disagreement, or the fundamental investing concept you would like us to discuss next. We read those carefully, and they help shape future episodes. Thanks for listening. See you next time.